What's up, everybody? My name is Joe Brown, and this is Heresy Financial. Right now, it looks to me like the stock market is currently headed higher in a final epic rally before a crash. Now, if you've been following me for a while, you know that I was forecasting a crash all the way back in 2019. And then when it was crashing in 2020, for other reasons than what I had originally thought, obviously, I thought it was going to go much lower. I underestimated the impact that the Federal Reserve would have at first. But then in April or May of 2020, I changed my mind and I've been bullish on the stock market ever since. Now, I think we are nearing the end. And just like the Federal Reserve helped put the bottom in March of 2020, I think they are going to help put the top in 2022. So in this video, I'm going to explain to you exactly what the Federal Reserve is going to do that's going to cause a crash, when the Federal Reserve is going to do this, and number 3, how the mechanisms work that will make it play out this way. Ready? Let's dive in. Okay, so at this point in long-term economic cycles, you've seen the financialization of everything. Near the end of the dominance of economies that own the global reserve currency, everything becomes one trade. Business, land, and stores of value all move in tandem against the currency at the sole discretion of the central bank. We have seen over the last 2 years now an unprecedented expansion of both the money supply and the intervention in our economy by the central bank. The results have been record high asset prices and record-breaking inflation. Now, at this point, the Federal Reserve faces the unpopular decision of pulling back on its easy money policy. Historically, this comes in 2 forms, either raising interest rates or selling assets. Because in contrast to what they're currently doing, which is buying assets, they're taking assets out of the economy and injecting new money. That adds money to the economy. When they sell assets, that extracts money out of the economy. It contracts the money supply. Now, they've stated very clearly the economy is not yet strong enough to raise interest rates. So the first thing that they plan on doing is reducing their amount of asset purchases until they get to 0. And then after that point, they will start selling and raising interest rates at some point. So what is the timeline for this? When will this tightening happen, and when will this tightening cause a crash? Well, a crash as a result of tightening will definitely not happen until at least tightening begins. So that pretty much rules out this year, because they've stated that they are going to let us know when it's going to happen. It's coming up in the end of the year. So the earliest that they'll begin to lower their asset purchases is closer to the end of this year. But it does take a little bit of time for the effects of monetary policy to be felt in an economy. So it likely will not be instantaneous. But how long will it take? Well, we have to take a look at the Federal Reserve's timeline for tapering. If all goes according to the plan, the Federal Reserve would like to have their total asset purchases per month down to 0 purchases by the end of 2022, if not a little bit earlier. This is a fairly aggressive timeline for reducing their current minimum of $120 billion worth of asset purchases every single month. Now, here's the kicker. This tapering will also begin at the same time in which we're likely to see the passing of spending bills and the beginning of massive spending plans by Congress to the tune of $1 trillion here, $2 trillion there, potentially much more. We also know that the government can only spend this extra money by borrowing more. Now, they get a fairly low interest rate on their debt that they're borrowing because they've got a buyer of government bonds in the system right now buying at least $80 billion worth of bonds every single month. We also know that bond prices and bond interest rates are inversely correlated. So if you've got a buyer, the Federal Reserve, buying $80 billion per month, keeping prices high and keeping interest rates low, and then that buyer leaves right at the same time as demand for borrowing picks up and they want to borrow more, that is going to have an effect of raising interest rates. So even without the Federal Reserve raising the federal funds rate, which is the only interest rate that they directly control, you're going to see an increase in yields, an increase in interest rates across the yield curve. This means that over the course of 2022, we will see an increase in interest rates. We will see a slowdown in the growth of the money supply, if not an outright decline in the money supply, and at the same time, probably a blow off top in stocks, as they currently look headed much higher. These three things in tandem paint a very ugly picture that almost certainly point to a crash happening sometime in 2022. And here is why. Prices are information. If total pizza production this year gets cut in half, then total pizza consumption must also get cut in half. There's no way around it because the pizza that's consumed is the same as the pizza that is produced. So if pizza production does get cut in half, there must be information sent out to everybody that somebody is going to have to consume less pizza. Now, this could be done top down with a small committee of highly educated people deciding, hey, you over here, you're going to consume 0 pizza this year. You get to consume all the pizza you originally would have, making the decision based on purely fair and unbiased reasons, mainly lobbying and their pockets being lined through bribes. However, in a free market, and for this example, we're using a purely free market, the pricing system is how information is distributed about relative scarcity of goods and services. So if production of pizza is cut in half, prices will double, let's say. Now, if the price of pizza doubles, there will absolutely be some people who will say, I'm going to buy the exact same amount of pizza, prices be damned, I will get my pizza. And then there will certainly be others who look at the price doubling and say, I'm just not going to buy pizza. So in free markets, prices are unfiltered information sent out through the economy about the relative scarcity of a good. What most people don't think about, however, is the price of money, because money has a price as well. The price of money is what we call interest rates. It's simply the cost you pay to get your hands on new money. So how does a free market handle the cost of money? Well, the same way it does it with pizza. Let's say interest rates are very low. This is going to signal a low cost of money, which means, remember pricing, scarcity, abundance, that means it is sending the signal that money is abundant. And in a free market, that would be the pool of savings. So the low interest rate environment is sending a signal that there's a massive pool of savings to draw on. It means the savers are competing to get their money put to work. If I want to borrow, I can shop different lenders as they try and outbid each other, offer lower and lower rates in order to get my business. Once I borrow, I put that money to work, and remember, no fractional reserve banking. This is not an expansion of the money supply. This is simply the signal saying, relative to everything else, money is abundant right now. Now let's say the opposite situation. Interest rates are very high. Who has the advantageous position here? The saver, the lender, because borrowers are now competing for capital because money is scarce compared to the stock of goods and services. Borrowers are offering higher and higher rates until they win and they can get their hands on that borrowed capital. Again, remember, the total money supply isn't expanding or contracting here. It is only abundant or scarce relative to everything else in the economy. So low interest rate environment, this is a growth period. It's sending the signal, hey, be risky, take risks, deploy capital, spend it, take out debt. Low risk environment right now encourages growth. The capital resources are there. In a high interest rate environment, those resources are very low. Therefore, the signal that it sends is high risk. Don't borrow money unless it's very worth it. Be very careful how you spend your money. Don't take large risks. We need to preserve the capital stock, and it incentivizes then new savers. Build up that savings pool because it's giving a large incentive. It's a high interest rate for anybody who does have savings. So it incentivizes now, since those capital resources are depleted, build that back up. That savings pool is small. The system says build it bigger. Now enter the interventionistas, the ivory tower elites, the Harvard intellectuals who think that they can outsmart decentralized freedom with a few PhDs who have no real world experience. They look at this system and they say, I can do better. And then with a monopoly on the creation of money, control of the banking system, legalized fraud called fractional reserve banking, they control the expansion or the contraction of the money supply and interest rates. Remember, interest rates are the cost of money. And remember, prices send information about the relative scarcity or abundance of anything, including money. So when the Federal Reserve decides to lower interest rates, they are sending information out into the economy that money is abundant, that the savings pool is massive and abundant and is primed for growth. But That's not reality. They are sending a false signal. The savings pool is not large. It's very small. This causes investing, debt, and spending in a way that is not in line with economic reality, because economic actors make decisions on false information. This is what some economists refer to as a misallocation of resources or malinvestments. You build something on the assumption that the boom that's going on right now is real, when in reality it was fake and it only looked like it was there as a result of the fake money expansion. Now, at this point, the central bank has two options: continue their game and let the currency collapse, or pull it back and watch the fake growth collapse. And in the last 10 years, almost every single market crash has been associated with some form of Federal Reserve tightening, whether that's raising interest rates or selling assets. Because both of these are withdrawing currency from the system when they've just spent a significant amount of time sending a signal to the system that the savings pool is large and abundant. And the following increasing scarcity of money pulls the house of cards down. So in reality, it's not the tightening that caused the crash. It is the manufactured boom that made the crash inevitable. So in summary, we know that the Federal Reserve plans to begin tightening at the end of this year. They will be on an aggressive timeline to reduce their asset purchases to zero well before the end of 2022. This will inevitably push interest rates higher because it will coincide with much higher government borrowing. And just as monetary easing caused the boom over the last year and a half, so will monetary tightening cause the crash next year, because the easy money sent a false signal to the economy that caused malinvestments, and the tight monetary policy will slingshot the economy in the other direction as the misallocation of resources takes its toll. And finally, if you haven't heard, I will be in Miami from November 12th through November 14th for Mark Moss's Market Disruptors live conference. It's going to be a fantastic event focused on surviving the Great Reset. I would love to see you there. If you can make it, sign up. I've got it linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.